All right, good evening. So today we are going to be taking a look at the investment holding that we hold in the portfolio that allow us to generate passive income to reach financial freedom. This video is a continuation of the last video, the portfolio unveil. So if you haven't seen that yet, please check it out. I'll put a link somewhere along the line. So for those who don't know me, my name is Tony. Me and my wife achieved financial freedom in 2024 and decided to put a plug and traveling. Currently, we are in Thailand. So with no further ado, let's take a look at the portfolio. Okay, so right now it's 9:30 p.m., which is market just open in the US. So ignore the number over here. It's going to be changing quite a bit. So today we're going to be looking at the three main funds that I use to generate passive income. So before we get into that, what are the criteria that we look for in these funds? So of course the return, the distribution, the the record, the history, because I think I mentioned last video as well that the cover call ETF sectors are quite new. So the more data, the better. The more we can look back and see how they perform historically, the better. And also the fee. We want to look for something with the lowest fee possible. But it is the fact that it is a little bit more hands-on kind of management. So the fee is going to be higher than your typical passive funds like S&P 500. So we're not really going to be talking about other funds today, just going to focusing on the cover call ETF that generate us the passive income. Certain fund like VFV, the Vanguard S&P 500 is pretty self-explanatory, so we're not going to be talking about it today. So let's with no further ado, let's take a look at the first one, which is going to be CI Tech Giant Cover Call ETF, ticker TXF. This one is from CI Global Management. This one been around a long time. Inception date 2011. But then you might not, if you follow the cover calls ETF scene, you might not hear about this one as much. Partially, I think that they don't run a lot of marketing campaign around their fund. Maybe they do, I just don't really see them. But they've definitely been around for a long time. The asset under management is quite healthy, sitting at about $650 million. So you don't have to worry too much about, the volume, how liquid it is. You'll be able to trade in out of this one, no problem. The fee right now is sitting at about 10%, but they are paid quarterly, and every quarter it varies depending on how volatile the market is. Because we know the option premiums are based on volatility. The more volatility, the higher the premium. The fee of this one is sitting at 0.65, and then MBR is sitting at 0.71. If we go over here, I have a little bit of like a put together. So the 0.71 is the MER along with the trading expense ratio, which is 0.07, leaving us 0.78, which is the final fee that we pay. So let's take a look at a bit about their strategy. So I have this cut out from their prospectus. So the fund trade on 25 largest tech company in the US, and technically it's the world, but then it's mainly US really. They are only selling cover call based on the 25% of the total holding. So this means that 75% is actually be left alone to grow organically. So then you kind of have the upside that you can kind of expect from this fund a little bit more. Um, Being the longer holding fund, you get to see a little bit more data in terms of how it performed during the COVID and stuff like that. So this one since inception performed about 15.5% per year, which is quite nice. And then the past 2 years, 33.7, because the past couple of years been pretty crazy bull run, you could say. So what makes this one different? So this one is mainly focused on tech, but it is not, how do I say it? It is not market weight. So what market weight means that, let's say if you buy $100 into a Nasdaq, you're gonna get maybe $10 of Nvidia, $8 of Apple. So they're gonna be based on the size of the company. But this one is actually equal weight. Okay, let me go to the portfolio page here. So basically, everything, the top 25 tech companies actually weight equally around 4%, and then they rebalance every now and then. So, what is this good or bad? So it really depends, right? The past couple of years, the big tech, the Mac 7, Nvidia, Microsoft, Apple, they've shown a significant growth. So of course, if you weight heavily on those, you're gonna overperform. But if you weight equal weight, then you're gonna lag behind. But so is it bad? So basically, if you think that other tech company gonna be able to catch up, over time because market goes in cycle, right? When we big tech today, small tech tomorrow, we don't know. So if you think that could be the case, this one might be for you. Another thing that made this fund underperform lately is because of the US dollar, because this one is an unhedged unit. What does it mean is that as US dollar go up, this one is actually trading in Canadian dollar. It kind of suppressed the price a little bit, make this one kind of stagger a little bit. I like the fact that it is equal weight because it allow us to be able to touch on a little bit more variety of tech company. And this one is long running and then decent level of fee. So this one is one of our longest holding fund right now. Okay, the next fund on the list is going to be Evolve Nasdaq Technology Enhanced Yield Index Fund. My goodness, that's a mouthful. Ticker QQQY. Don't mistake this one for the Defiance one. This one actually traded on the Canadian market. It's a totally different company. So this one pay a whopping 14% yield, almost 15, almost too high. I think they were paying like around 10 before, and then they up it to current amount. They're paying about 32 cents per share at a price of about $26 per share right now. This one is from Evolve. This one, different from the TXF, is basically market weight. So what it means is that you're gonna be if you buy this one, you're gonna be holding a lot more of like a large cap tech, like right now Broadcom, Meta, Microsoft, Apple. Broadcom is growing a lot recently, so that's why I think they're pretty heavily weighted right now. I'm sure after the rebalance they might come down a little bit, but this strategy definitely do better in the recent market just because the concentration of growth has been focused on the larger cap tech. Um, this one actually have quite a high fee. You would take a look at here. The fee was zero point 0.5. Sorry, let me just go here first to show you. So the fee is listed as 0.5. However, MER is 0.72, and then the trading expense ratio is 0.58, ending up being 1.3% fee. So the trading expense ratio is quite high. This probably means that they are very active in terms of like selling cover call. Maybe they sell much more aggressively, maybe weekly. We don't really know for sure. But the fee is definitely quite high. So why does this one a good contender? So let's go to total return calculator here. So QQQY actually perform extremely well against the index, the Nasdaq. They actually outperform Nasdaq by quite a good margin. And then among all the other similar, cover call ETF, the QQY actually outperform most of them. Like HTAE is just an example here. It actually one of the one that really performed really well and actually on margin. And QQY actually outperformed it by a small increment, which is quite impressive, really. So, oops, sorry, wrong one here. So QQY again, typical strategy, out of money cover call, but they sell up to 100% of their whole portfolio in cover call. So everything is going to be depending on what the portfolio manager think is appropriate, but they can sell up to everything, right? The cover call can be 100%. So combining this with the high payout, it makes sense. And then with such a high dividend rate, you're probably not going to get a lot of capital appreciation from this one. But as a total return, this one so far performed really well. Despite being high fee, I just want to give this one a try and see how it goes. So some of you might ask, why do you care so much about the fee? So let me go to this. I have this one saved up. So this one is a T-Rex score by Larry Bates. He's author of Beat the Bank book. Quite a good read actually if you found him in the bookstore, probably mainly in Canadian bookstore. This is quite interesting. So basically what this calculator does is that it shows you how fee matters in your investment. So let's say you have $100,000 in initial investment, 8% annual return rate, 2.5% fee with a time span of 25 years. If you calculate it, it showed TX Corp 48%. That means that it's gonna sound really crazy. If you have 100,000 invested with 2.5% fee after 25 years, 52% of your whole portfolio is lost in fees, right? Because you can see these two lines, it gradually This is one line is basically without fee, one line with fee. Over time, it creates such a huge difference. And then, these are all math, by the way. This is not like some voodoo magic, right? This is all mathematic. But if you lower the fee down to, let's say, 0.75, you actually get to keep 81% of your portfolio. You still lost 19%, which is quite big. But you can see how much small fee makes a big difference in the long run. So doesn't mean all fees are bad. No, some fees are actually definitely worth it. Like some fund manager has proven that they charge a high fee, but they actually outperform the market by a good amount. But then a lot of time they charge high fee, but you don't have anything to show for it yet, right? In the future they might do well, but you don't know. So just something to keep in mind when you pick these funds. You want to make sure that you want to give your money the best chance to succeed. And one way it could be through like a reasonable fee. So that's why I always talk about fees and stuff like that. And then I'm also cheap, so okay. So the final fund is gonna be USDC Global X S&P 500 Cover Call ETF. As name suggests, this one gonna be based on S&P 500. This fund actually used to be owned by someone else that now Global X. They used to be named US Large Cap, not fully S&P 500. But then this one went through a lot of evolution, I would say, to the current iteration, which is I think is my favorite. The annual dividend yield is about 10%, which is quite nice, a little high, but it's good. So one thing I like about GlobalX website is that they are very upfront about all the details, right? They actually show you MER right up front, or your trading expense right up front. A lot of fun. You have to dig through the filings, your prospectus, your ETF facts to find all the information. But GlobalX actually have it up all here to see. The fund also been around for a long time, since September 13, 2011, I think. But the graph only showed to 2012 for some reason. But anyways, so it's actually been around for a long time. The fee is very competitive, probably one of the lowest in the market right now in this sector. Only losing out to I think the new JP Morgan one that was introduced recently. But combining low fee, good dividends, and good track record and everything like that, this one actually one of my favorite. So let's take a look at the info here. Okay, so this one is a bit outdated, so ignore this part. So of course, strategy is up to the portfolio manager discretion, but this way you can actually look back and see the data, right? They actually been around for a long time, so you can actually see how much they do in the past. And since inception, they actually yield perform 11.35% overall per year on average, which is actually really nice. And Global X actually went through a lot to make the fund much more efficient, right? So now they are vertically integrated, so they actually sell cover call on their own Global X S&P 500 Index ETF. So this saves you some fees of like, instead of buying like a outside fund and sell cover call, they actually do it all themselves. This fund sell up to 50% of the cover call on the portfolio, so 50% are allowed to grow organically, while the other 50% are being layered with cover calls, and then show in the filing right here. So I had a circle right here. So yeah, those are basically, so that's it. Those are basically all the fund that we use to generate passive income to fund our financial freedom. I had the whole strategy laid out in different videos, so check it out. This is just a part of it that is cover call layers. We actually have like a different portfolio, like more growth related, more fixed income related, but this is a part of the whole picture, right? So yeah, let me know what you think. Um, I'll come up with more video later, but then if you anything else you want to see, please let me know. So for now, have a good day. I'll talk to you guys next time.